I want to share with you an example. Of course, to calculate unit economics, you need good data, and usually the venture founders have access to the data, and the investors have access to the data. But usually, because these are private companies, researchers like me find it difficult to get hold of good data, right? So Luckin Coffee was is a very innovative business model in China that challenged a very strong incumbent, Starbucks. Starbucks today has 3,600 outlets in China. In comparison, they have about 200 odd outlets in India, right? So China for Starbucks is a very, very important market. Surprisingly, because China is a tea drinking country, okay? Luckin Coffee, Starbucks has been in business in China for 22 years. They opened their first outlet in Beijing in the year 2000. Luckin Coffee was launched just a few years ago. Okay, I'll just share with you. Founded in 2017, and they're already bigger than Starbucks in number of locations. We'll talk about how their locations are different from Starbucks. If you look at the last bullet point, they have 5,671 locations in just 5 years. Okay, but just to give you an idea, China is a tea drinking country with a very low per capita consumption of coffee. So in tier 1 cities, it is 20 cups per person per year. But if you take the average for China as a whole, we are looking at 4 to 5 cups per person per year of coffee, right? Whereas in countries like Finland and Sweden, you're looking at 1,000 cups of coffee per year. So the way to think about this is to say that there is significant headroom for growth. And this is just to illustrate that the market is expected to grow very fast, both in terms of number of cups consumed per capita, as well as the total value of the market. So this was a company founded in 2017, received significant, venture capital funding in multiple rounds from well-known funds, including the Singapore Sovereign Wealth Fund, GIC. It listed on NASDAQ in 2019. In 2020, they ran into some difficulties because of their some reporting practices. But let's just assume that their data are sound. So most of the data that I'm sharing with you are from their IPO prospectus. So they fundamentally have 2 types of stores, okay? One is what they call relaxed stores. These are like these Starbucks stores where customers can go in, order coffee, sit down and enjoy their coffee, or work or study, right? Many students can also do this. So these are the typical coffee shops that we all know: Costa Coffee, Coffee Day, Cafe Coffee Day, Starbucks, and so on. But the 97% of Luckin's outlets are actually pickup stores where customers don't have any place to sit down. So I'll tell you how they order their coffee. They pick up their coffee and then they leave. So basically, the founder of Luckin Coffee does not believe that theirs is a coffee company. She believes that theirs is an internet company. So basically, the customers, this right column here is Luckin. There's a Luckin Coffee logo. It looks like a reindeer, as you can see. The left one is the Starbucks coffee, the order in terms of the order process, right? So the customer walks into the store in the case of Starbucks, orders the beverage, pays by cash or credit card or online, right? With a QR code, and picks up the beverage and either consumes it in the store or takes it away. With Luckin Coffee, you have to pre-order your coffee. There is no alternative. Okay, so you have to download the app, and most people actually use the Luckin wallet to pay, but you can also pay using WeChat Pay or Alipay. and then they place the order and they pick up the beverage and they leave, or they can receive it via delivery. So the model is actually quite different, okay? Very low in terms of real estate assets, and the focus is on the coffee itself, whereas Starbucks is offering an experience, right? Starbucks' value proposition to coffee drinkers is that a Starbucks outlet is like their third space. The first space is your home, the second space is your workplace, and the third space for most, regular Starbucks customers is the Starbucks outlet. That is not the value proposition of Luckin Coffee. Luckin Coffee's value proposition is a cup of coffee, basically, not the experience. And they also price their coffee significantly below Starbucks coffee, okay, and also below the prices, of well-known brands such as Costa Coffee. They use well-known actors as brand ambassadors. And initially they were charging a delivery fee of 6 RMB if the order size was below 55 RMB. But this, the delivery actually accounts for less and less of Luckin Coffee sales, because there are so many outlets now that most customers actually pick up the coffee themselves. Okay, so basically it's a viral strategy of acquiring new customers. These are the customer acquisition costs. You can see the customer acquisition cost. The red line is the total customer acquisition costs, declining as the brand becomes more and more well-known, as the footprint of the brand increases in China. The lower line, the yellow line, is the promotion, the costs of the promotion. Okay, the red line includes the promotions, and the yellow line is only the promotions. So as I said, they are use promotions very aggressively. Buy 2 get 1 free. This is what the circle here means: buy 2 get 1 free, or buy 5 get 1 free, right? Which is the same as saying buy 1 get 1 free, right? If you buy a minimum of 5, you get 5 coffees for free. They've also used buy 1 get 1 free on many occasions. So from the IPO prospectus, we saw that this is the customer retention rate. Now this figure may be a little complicated to interpret, so I'll try and explain it to you. So basically, each of these lines is a cohort. Okay. So for example, if you look at this line at the top on the left-hand side of the figure, it's light green. It corresponds to customers who became customers for the first time in February of 2018. Okay. So these customers, M1 is 1 month after they bought for the first time. So out of 100 customers that bought from Luckin Coffee in February 2018, by March, only about 38% had made a repeat purchase. So that means 62% of the customers that bought in February did not buy in March. Okay, this figure dropped further to about 30, I would say a little over 30% in April, went up a little bit in May, dropped again in June, dropped again in July, started picking up in August, September, October, November, December, dropped again in January, and then M13 in February, it picked up again, right, to about 35%. So this is a cohort-based, cohort-based analysis of purchases by customers. And because they oblige every customer to pay through an app, they have abundant data. They can actually cut and dice the data as finely as they want. So this gives us an idea of the customer retention rate. Okay. And then the transaction value per customer is again the same, right? You take the transaction value, again, you have a cohort-based analysis, right? So you have, for example, the February 2018 cohort spending a little over 60 RMB in the first month of their purchase in M0, dropping to about 55, staying in 55, dropping again, picking up again, and so on, going up and down, right? What we don't know is what effect the promotions are having on this up and down movement of the transaction value per month, right? So we can safely assume that when there is a spike in the transaction value, it is normally because the company has offered that group of customers a very aggressive promotion. So we actually did a very detailed unit analysis of Luckin Coffee, okay? So we looked at a sit-in store, what they call a relaxed store, like a Starbucks store, which is in a basement in the center of Shanghai. It's called People's Square, in the center of Shanghai. And the outlet is quite small. It's about 30 square meters with a very few tables. The rental there is about 15,000 RMB, which would be about 1.5 lakhs per month. Utilities are about 3,400 RMB per month. 5 workers per shift, working 2 shifts. The average worker gross salary, including all costs for the company, including social security and so on, is 4,636, which is about 46,000 rupees. We take a cup of latte as our reference point because that's the most consumed product. And the delivery fee, as I mentioned before, is 6 RMB. But we can safely ignore deliveries because we have evidence that deliveries accounted for less and less of their sales. What we know is the raw material costs per cup are actually very low. So this is very similar to Starbucks cost of raw materials per cup. So 24 RMB is the selling price. Raw materials account for 5.4 RMB, and the average monthly revenue per customer is 49 RMB, and that is based on these curves. We use these curves to calculate the average transaction value per customer, and the average churn rate. Again, we use this figure to calculate the average churn rate. So we concluded that at the end of 1 year, at the end of 12 months, roughly 31% of the customers were still with Luckin Coffee. Okay, and we know from the prospectus that a sit-in store sells about just under 6,000 cups per month. So with this, let's do some unit analysis, right? So the profitability per cup, if you take the cup as a unit, we are looking at a selling price of 24, raw material cost of 5.4, which is 18.6 is the contribution margin, and the contribution margin as a percentage is 77.5%. If you factor in promotions, right? If you take the example that all sales were made with buy 2 get 1 free, right? Then the contribution margin drops to 66%. If you take an even more, let's say, pessimistic assumption and assume that all sales were made with the buy 1 get 1 free promotion, then the contribution margin drops even further to 55%. But notice that even with such an aggressive promotion, the contribution margin still seems to be quite healthy, right? And here is the insight from this, right? So when you have a very high contribution margin on your product, it pays for you to use promotions as a customer acquisition strategy because the customer is perceiving 24 RMB of value, whereas the cost for you of that promotion is only 5.4 RMB, right? So this company was very intelligently using promotions as its main strategy for acquiring new customers. If you look at profitability per store, right? So basically the way to calculate this is fixed cost per store divided by the contribution margin ratio. So the fixed cost per store are roughly 65,000 RMB or 6.5 lakhs per month, right? And therefore the break-even volume is 64,760 divided by the contribution margin, which is about 83,000 RMB per month. So how many lattes, cups of latte, does the company have to sell in order to break even? Roughly 3,500. And this represents about 18 days worth of sales. So for 18 days, the company is just paying for its overheads. Starting from the 19th day, the company makes a profit, a profit on the store. Now, what happens if we factor in promotions, right? With buy two, get one free, remember that the contribution margin has now dropped to 66%. The break-even sales value goes up. So now they have to sell more cups to break even, more than 4,000. And this represents 21 days of sales. So the company is spending 21 days just paying for its overheads and has 9 days to make a profit. With the most aggressive promotion strategy, and with this contribution margin of 55%, the company's break-even sales value goes up to nearly 120,000 RMB. The company has to sell nearly 5,000 cups to break even, which represents 25 days of sales. So if this is the scenario, that the company has to resort to very aggressive promotions in order to make its sales, then the store level profitability is not looking that great. Okay, so I would be worried, for example, if they were consistently having to resort to buy one, get one free promotions to acquire their customers, which means that at the store level, their break-even is actually quite high. What about profitability per customer, right? So here, I use a very kind of a back of the envelope calculation for customer lifetime value, which is basically revenue from customer during the period times the contribution margin ratio divided by the churn rate of the customer for the same period, right? So this is the customer lifetime value. So 49 RMB, if you want to do this for per year, times 12 months, times 77.5% contribution margin, divided by 68.6%, which is the churn rate. So you're looking at a customer lifetime value of 664 RMB. The customer acquisition costs, right, which is from the slide, this slide here, right? So I took the average. The customer acquisition cost is 50.34. Okay, so if you compare 664 to 50.34, the CLV to CAC ratio, looking at 13.2:1. It's actually looking very healthy, right? Even if you take the worst case scenario and say that 103 is your customer acquisition cost, it's still looking quite healthy. Now, what happens if you factor in promotions, right? If you factor in promotions, the difference is that in the numerator, the contribution margin has dropped now to 66%. Okay, so now the customer lifetime value goes down to 565 RMB, but the CLV to CAC ratio is still a very healthy 11.2. And the same with the buy one, get one free promotion. The CLV goes down to 471, but the CLV to CAC ratio is still a very healthy 9.4:1. So this is basically how we calculated the average monthly revenue per customer, average retention rate per customer, and therefore the average churn rate per year. So basically the conclusion after having done the unit analysis for Luckin Coffee is that the per cup profitability is very attractive, which we know, from other coffee businesses in the world. The per customer profitability also looks very robust. The per store profitability is a worry, especially if they rely heavily on promotions, which seems to be the case. However, since sit-in stores only represent 3% of the total outlets of Luckin Coffee, we don't need to be too worried about this, right? So my conclusion after having done the unit analysis was that this is a very, very robust business, a very robust business model. And if they can take some additional actions, such as weaning customers away from promotions slowly, improving and therefore improving the retention rate of customers also, and improving the monthly spend per customer, perhaps by offering other products also, right? When you go to a Starbucks, you buy a croissant, or you buy a sandwich, you buy a wrap, you buy sometimes bottled water, juices. So there are so many other things that Luckin could offer, right? So if it can improve, if it can act on these areas to improve these, the unit analysis, the unit economics of its business, then this could be a very, very attractive business indeed.